Corporate Finance Practice Problem using Onenote. 5-year MACRS Depreciation, Weighted Average Cost of Capital, WACC, Cash Flow, and Net Present Value. Get ready. It's time to take your chance with Corporate Finance. Here we are in Onenote. If you have access to Onenote and would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side in the Practice Problems tab down in the 1242 5-year MACRS Depreciation, WACC, Cash Flow, and Net Present Value tab. Also note, when using Onenote, look at the Immersive Reader tool. Our presentations up top will be mirrored down in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Information up top, we're going to go through the calculations then on down below. This will be another comprehensive type of problem taking into account many different concepts that we have talked about in prior practice problems. The idea here being we have an initial investment going down. We're going to be receiving some kind of benefit in it in the future. We want to think about the cash flow results so that we can then use our time value of money tools, including the net present value, to make our calculations and determinations as to whether or not it be something we want to take on or not. A couple new things that will be involved here, including the weighted average cost of capital calculation to see what the discount rate will be used when we think about the net present value calculation. So we're going to have the 5-year MACRS asset. That's what we're going to be putting the money down on, the purchase for $500,000 of the fixed asset. We're also going to say that there's an added amount that we need to invest that we're going to say is working capital or something like a deposit that we expect to get back at a future point in the series of future events. We're going to get an inflow of it back. So we're going to put down upfront the $120,000. The amount returned that we expect to get back from that $120,000 is in 6 years for the $100,000. So that's going to cause an outflow upfront in cash, inflow later on. Although we expect to get basically the $100,000 back, we still had to give it up for a certain point of time. Therefore, it couldn't be earning a return on it. And so we want to consider it in terms of our time value of money. We're saying we're going to have a cash flow benefit from the purchase taking place here. That's going to go from periods 1 or year 1 through 6. So in period 1, $300,000 benefit, 2, $240,000, 3, $190,000, 4, $140,000, 5, $120,000, 6, $99,000. Tax rate, we're going to say, is the 35%. And then we have our cost of debt, cost of preferred stock, and cost of equity amounts here and their weights, which we can then use to figure out our weighted average cost of capital, which we're going to assume is our required rate of return, our cost of capital or discount rate that we will then use when we do the net present value type of calculation. Okay, so first thing, we're going to be looking at the depreciation because we are looking once again at a depreciable type of property. And depreciation, you'll recall, is going to be a cash, accrual related thing. It's not a cash thing. And we're trying to make our decision on a cash basis. And we know that the $500,000 is already going down, so normally we would not need depreciation, but the depreciation affects when we get to deduct or get the tax benefit of the deduction of the money we're putting down right now, and therefore it does have an impact on a cash basis for taxes. So we're looking at depreciation, not book depreciation, not generally accepted accounting principles or accounting depreciation, but tax depreciation. We have to determine what kind of asset it is and what we're going to depreciate. Remember that the tax depreciation has an accelerated depreciation, usually MACRS, but the law could change. It could have another accelerated amount like a 179 deduction or some kind of special deduction up front. So be aware of that. We're going to assume here the MACRS depreciation. Now you can go to the IRS website, irs.gov, irs.gov, type in pub or publication 946. Get more information on the depreciation. We're down here in that publication in table A1, which has the 5-year rates. So we could then apply these rates out and just multiply them times the cost to get the amount of depreciation for 1 through 6. Remember, there are 6 years because there's a half-year convention. I'm going to go through and recalculate it in essence and do a general calculation for it so we get some feel for what this depreciation actually is in comparison to something like a straight line or double declining. It's basically a double declining with a half-year convention, and it has kind of a smoothing out effect on this last couple of years. So we'll see that as we do the calculation. Let's start with that. So MACRS depreciation, we got the cost, $500,000, 5-year property. So if we have the straight line amount, let's just do that calculation, pulling out the trusty calculator. 500,000 divided by 5 is, of course, 100,000. That would be the straight line depreciation. I want to see the rate, though, straight line rate. 100,000 divided by 500,000, giving us 0.2 or 20%, which could also be found by taking 1 divided by the number of years, which is 5, 20%. Then for double declining, we take that, we multiply it times 2. So times 2, because we're on double declining, that's what makes it an accelerated method, 40% on the double D, the double declining. We're going to multiply that times the cost, which was the 500,000. That's going to give us the depreciation on a double declining method for an entire year of 200,000. But there's a half-year convention, assuming that we purchased the property in the middle of the year, even if it happened in January, even if it happened in December, we assume it happened right in the middle of the year. So we're going to divide that 200,000 by 2 to get back to 100,000, which is the same as the straight line rate, but it's really double declining balance half-year convention, which is important because when we go to year 2, we can't apply the straight line rate. We got to do the continue on with this double declining thing. Double declining business. So now we're going to take the cost, 500,000, minus the 100,000. That's our basically book value on a tax basis. Cost minus the accumulated depreciation, 400,000, times the 0.4 or 40% is going to give us the 160,000, 160,000. Then we'll take then the 400,000. Last time, that was our last kind of book value on a tax basis, book value on a tax basis, minus the 160,000. That gives us our cost, that's minus the accumulated depreciation, times the 0.4, times 0.4, double declining rate. There's our 96,000 there. Let's do it for year 4 here, because that's the next year that's in line here. We're doing this in order. And so now we're going to take the 240,000 minus the 96,000. Here's our book value on a tax basis, meaning cost minus accumulated depreciation, times the 0.4, gives us the 57,600. 57,600. Then, if we take then the 144,000 minus the 57,600, we're at the 86,400. And now we're not going to multiply it times the 40% because we're going to try to mirror what the tax code is doing here, which is kind of spreading out or evening out. In the last couple of years here, you'll see they use the same rate. So we'll just use the same amount just to give an idea, a feel for it if you were to calculate this out. It's funny tax code stuff, right? So now I'm just going to mirror this out instead of multiplying times the 40% like you normally would do in a double declining method. So that's going to give us the 57,600 again. And then the last one is simply a plug generally, meaning we had the 86,400 last time. We got the 57,600. That leaves us 28,800 left. That's what we're going to depreciate so that we fully depreciate the 500,000 over the 6 years because it's 5-year property with a half-year convention. So you can think about half of it basically happening in year, half in year 6, although year 6 is the plug because we front-loaded it because it's a double declining balance, and that's what double declining does. Let's add these up and see if we get up to the 500,000 again. 100,000 plus the 160,000 plus the 96,000 plus the 57,600 plus the 57,600 plus the 57,600 plus the 288,000 is the 500,000. We do indeed get back to the 500, so we allocate the cost over these 6 years. This is the period at which we get the tax benefit, even though the cash went out up front. So now we can do the calculation of, we're going to do the calculation now of our weighted average calculation. This will give us our discount rate, the discount rate that we're going to use when we do our present valuing. So we'll take this information that we're given, the cost of debt, the cost of preferred stock, the cost of equity, and the weights here, and we'll use that to calculate our WACC, weighted average cost of capital, which we'll use as our discount rate. So we're just going to say, all right, we've got the cost of debt, the cost of preferred stock, the cost of equity, just mirroring here. The weights then being the 30, the 65, and the 5. That adds up to, of course, 100%. Multiplying these out then, if we simply multiply these out, I'll do it with the trusty calculator here just for the fun of it. We then would take the 10% times the 0.3. That's going to give us then, one more time, 0.1 times 0.3 gives us the 0.03 or 3%. If we take the 0.12 times the 0.05, we get the 0.006 or the 0.6%. And then if we take the 0.17 times the 0.65, we get the 0.1105 or 11.05%. Adding those up, the 3, the 0.6, and the 11.05, we get the 14.65 weighted average cost of capital. That's going to be the discount rate that we'll use when we do our present value calculations. So what do we got next? The cash flows. That's what we're going to do next. So now we're going to take our earnings before taxes, which are going to be these earnings. These are the benefits that we expect to get from doing this. So we got the 300,000, the 240, the 190, the 140, the 120, the 99 for years 1 through 6. We're simply going to map those out here on a horizontal fashion, 1 through 6. We're going to add to that our depreciation now. So this is allocating the cost over the useful life on a tax basis, which we're simply taking from the calculation we did up top, adding those out over, noting that this is not a cash flow basis because we paid for it, we're imagining up front, or would if we were imagining to do this. And this is just the allocation for taxes because we do have a tax impact, which will be a cash flow impact, and we want to tie that cash flow impact to the proper year. So we got the 300 minus the 100 is the 200. The 240,000 minus the 160 is the 80. The 190,000 minus the 96 is the 94, and so on. Tax is then calculated. So let's do the good old tax calculation. We're going to take the 200,000 times the 0.35. We get the 70,000. Then if we take the 80,000 times the 0.35, we get the 28,000, and so on and so forth, calculating the tax impact, which does have a cash impact. Then we have the earnings after taxes, which we can subtract these out. The 200,000 minus the 70 gives us the 130,000. The 80,000 minus the 28,000 gives us the 52,000. The 94,000 minus the 32,900 gives us the 61,100, and so on. Then we're going to add back the depreciation because it's not a cash thing. We only took it out because we wanted to figure out what the cash thing was, which was the taxes, and we've done that. So now we're going to add it back in to get back to a cash basis because that's the basis we want to do our present value stuff on. So we take the adding of these up, 130,000 plus the 100,000 gives us 230,000. The 52,000 and the 160,000 gives us the 212. The 61,100 and the 96,000 gives us the 157,100, and so on. Noting that in year 6, though, we have this added thing, and this underline kind of throws things off. I shouldn't have an underline here, but down here under the 100, because we said that we had this added basically deposit or some kind of working capital that we put in place of 120 that we expect to get back in year 6. So we're getting that back in year 6. So if I add that up in year 6, we got to say the inflow that we expect to happen, 45,630 plus the 288,000 plus the 100,000 is the 174,430 for year 6. Now these are our cash flows now. And now, once we have the cash flows, you can just do the present value calculations as you normally would. Note, again, you can have a very complex system of what you think is going to happen in terms of inflows and outflows for cash. And you can, figure it out. And then as long as you get down to a bottom line number per year, you can then apply your present value calculations to that. Typically, to apply the present value calculations, you want to basically be on a cash method to actually look at cash flows. However, note that if money is going in and out all year, the method of using present value calculations is somewhat restricted because it does assume that the cash flows happened at the end of the year, because that's, how the cash flow calculations work. That simplifies the cash flow calculations. So that's just something to keep in mind, but you can see how we can apply this process out to use our tool here. So now we're going to do our present value calculations with the discount rate we calculated up top, which was the WACC, weighted average cost of capital, the 14.65%. That 14.65 is what we're going to use. That means that if we get a net present value that's positive while using that number as the discount rate, then that we have cleared that rate. That's why it could be called the hurdle rate, required rate of return, and we might take on the project. So that's going to be the idea. So we'll take then our cash flow, which is we're just pulling down from this information we did up here. We're just pulling this information down, same kind of columns. We don't have period 0 here. We'll add that after. And then we got the present value of future cash flows. So for example, the $230,000 that's discounted at the WACC rate that we just looked at one period back would be the $206.11. If you see the calculation in Excel, it would look something like this down below. Note that you could do this calculation with formulas. You could do it with tables as well. And if you want to see how to do that, look at the prior section, which we go into that in detail. With longer problems like this, even in test questions, they would have to limit the problem a lot if they're not going to allow you to use some tool like a calculator or the Excel, because doing these calculations by hand or even with a table would get quite tedious. In Excel, it would look something like this. We got the negative present value of the rate, which is the WACC rate that we looked at, weighted average cost of capital we calculated. We're using an absolute reference here, noted by the dollar signs. Then, comma, we got the number of periods, which is 1, which we're not typing or hard coding, but rather taking with the formula so that we can copy it across, comma, comma, because it's not an annuity, but present value of 1, future value being that $230,000. If we do the same thing, if we were to copy this formula to this cell, then the $212,000 discounted at 2% at the WACC rate, WACC rate, weighted average cost of capital, gives us the $161,283. Formula would be negative present value rate, same cell here, H19, that's the WACC rate, comma, number of periods is now going to be 2, but we didn't hard code it. We copied over the formula, which shifted from N11 to O11, just like we were hoping it would, comma, comma, because it's not an annuity, but present value of 1, future value then being that 212 there. That also shifted from N12 to O12 in our formula. If we continue this on, then the 157, 100 that's discounted using the WACC rate, 3 periods is 104,245. The 111,160 discounted at the WACC rate for 4 periods is 64,336. The 98,160 discounted at the WACC rate 5 periods is 49,552. The 174,430 discounted at the WACC rate for 6 years is the 76,803. Adding the present values up gives us the 656,829. Now we're going to take the amount of investment that happened at period 0, no present value in needed, because this happened at period 0. So present value would result in the same value. We have to take that 500 plus this basically working capital or deposit we put down. That would be the 620. So there's the 620. So the 656,829 minus the 620 is 36,829. Because that's a positive number, then we have cleared the WACC rate, the hurdle rate, the cost of capital, the weighted average cost of capital, and therefore might take on the project. Even if it were 0, that would mean that we had cleared basically that rate and may then take it on. The fact that it is a positive number is good. The higher the better. If we want to know what the rate is on a percentage basis, we can look at the internal rate of return. But before we do that, let's go down and calculate this using our vertical type of fashion, which we've seen in prior presentations, just to look at the data in another way, which is always good. So we've got periods 0 through 6 this time, and we're going to have our same series of numbers, except this time the payment that went out is up front. It's a negative number. It's at period 0. Then we have our cash flow, which mirrors our cash flow that we did in this horizontal method for periods 1 through 6. And now we'll simply present value this down in this format. I'm going to use a present value formula this time for period 0, even though not required to, because I would like this entire column on the outside to have present value formulas and then be able to copy them down so that the entire column is uniform. So I'm going to say negative present value rate. That's going to be our WACC rate again, H19, absolute reference given by the dollar signs, comma, number of periods is 0 here. And that's using a cell reference instead of hard coding or typing it in, so we could copy it down, comma, comma, because it's not an annuity, but present value of 1, future value then being the 620,000. So the result is still 620 because we are at period 0. If we copy it down, however, the 230,000 present valued at the WACC rate for one time period back, 1 year, 206.11. Formula, present value, rate, H19, same cell because it's an absolute reference, comma, number of periods is now 1, not hard-coded or typed, but rather using a formula, which you can see has been shifted down from V2 to V3 as we copied it down, comma, comma, because it's not an annuity, but present value of 1, and then we have the future value, which is the 230,000, which also moved down from W2 to W3. Continuing this on down, we got the 212,000, which is discounted back at the WACC rate for 2 periods is 161 to 83. Then we have the 157,100 discounted back at the WACC rate for 3 periods, 104,245. The 111,160 discounted back at the WACC rate 4 periods or 4 years, 64,336. The 98,160 discounted back at the WACC rate 5 years, 49,552. And finally, the 174,430 discounted back at the WACC rate 6 years is the 76,803. Now note, if we didn't have any discounting, we would be at the net cash inflow 362,850. After discounting, we still have a positive number of the 36,829, and this comparison is deceiving because you might think then that this represents what we got after, say, inflation, time value of money, meaning the cost of just the dollar going down in value. That's not the case, because this, even if this was 0, that would mean that we still got a benefit over and above just the cost of inflation because we got the rate of return we wanted, which was included in the discount rate, the WACC rate, the weighted average cost of capital that was used. So the fact that this is bigger than 0 is good. That means we cleared the weighted average cost of capital rate, but we don't know exactly what the rate is. That would be the internal rate of return, which could be calculated in Excel by taking equals IRR, then this set of numbers, the negative number being, negative number, the amount we spent, outflow, and then down to this 174,430. That would then give us the 17.11%. So that is the percent, the internal rate of return being the percent at which the net present value calculation would result in 0. So we know then the fact that it's positive. That means we cleared the hurdle rate. Good. That's good. We might then take on the project. If we want to be more precise as to what the actual rate was, we use the internal rate of return, which would be the rate at which the net present value calculation would equal 0.